You follow the speed limit, avoid accidents, and keep your record clean. But when you open your renewal notice, the bill is higher anyway. This is a widespread trend. Car insurance premiums have climbed across the entire industry since 2022. The flat line represents your stable individual driving risk. This climbing line tracks the average cost of coverage. Carriers pay more for repairs, face parts shortages, and handle higher accident frequencies nationwide. These industry-wide expenses are passed down to everyone. Insurance companies price risk. Because they price the risk of the whole road, lowering your bill requires a different approach than asking for a discount. Bringing your premium down requires either taking on specific micro risks yourself or investing administrative effort. Navigating these industry-wide hikes requires a precise reallocation of your personal financial risk. Every savings strategy carries a different weight when you measure the effort required against the actual impact on your monthly bill. We can plot these options on a quadrant chart. Across the bottom is the input of your time or money. Up the side is the potential reduction to your premium. Policy bundling sits in the top left quadrant, low effort, high impact. Consolidating your home and auto insurance under one carrier usually takes a 10-minute phone call and yields a premium drop ranging from 5 to 25%. The trade-off is minor. Bundling makes it slightly more difficult to shop for individual coverage lines later since they are tied together. Hidden discounts also occupy this low-effort, high-impact quadrant. Carriers rarely apply discounts for paperless billing, low mileage, or safety features automatically. You have to ask for them every year. These strategies require minor administrative action and carry zero financial risk for you as a driver. Other strategies offer significant savings, but require you to absorb a calculated financial risk. This graphic shows the logic of a deductible shift. Raising your deductible from $500 to $1,000 typically reduces your collision and comprehensive premium by 10 to 20%. This approach requires you to have $1,000 liquid in an emergency fund. Without that cash, an accident could leave you unable to pay for repairs. You can apply a similar logic to older vehicles by comparing your car's market value against the annual cost of protecting it. For a vehicle worth less than $3,000, the math often favors dropping comprehensive and collision coverage entirely. By erasing that premium cost, you accept that the carrier will pay nothing for your vehicle if you cause an accident or hit an animal. Shifting insurance costs into personal micro-risks succeeds only if your bank account can safely absorb a total vehicle loss or a sudden out-of-pocket hit. Long-game strategies do not immediately fix a monthly budget, but they alter your baseline rate over time. We plot defensive driving courses in the high-effort, moderate-impact quadrant. The cost is roughly 3 hours of time and a fee under $30. In return, you get a 5 to 10% discount that lasts up to 3 years. Always verify that your specific carrier approves the course before you enroll. Credit score optimization sits at the far edge of high effort. Improving your score requires consistent behavioral change over 12 to 24 months before you see a lower rate at renewal. These high-friction tactics are tedious, but establishing a lower baseline risk profile creates compounding savings year after year. Spotting fake savings is just as important as finding real ones. Discount carriers often quote lower rates by stripping out essential protections. Verify a new quote line by line against your current policy to catch quiet removals of coverage. Trimming overlaps like duplicate roadside assistance or rental reimbursement is safe. However, liability and uninsured motorist limits are absolute boundaries. These stay highlighted in red and must never be reduced. Slashing liability to state minimums might save $15 monthly, but it leaves you personally responsible for massive medical bills if you cause a wreck. Uninsured motorist coverage is equally vital. With many drivers carrying zero insurance, this coverage serves as your shield against other people's mistakes. Aggressively cut overlapping conveniences and administrative fat while fiercely protecting the walls against catastrophic debt. The right path depends on your current cash reserves and the vehicle you drive. If you have a healthy emergency fund, raise your deductible to $1,000 and bundle your policies today. If you drive an older, depreciated car, check the market value. Drop collision coverage if the annual premium cost approaches the value of the vehicle. If you are living paycheck to paycheck, avoid high deductibles. Focus instead on low mileage discounts and usage-based tracking programs that reward your actual habits. If you decide to switch carriers for a lower introductory rate, perform one final check. Look up the Carrier Complaint Index on the NAIC database. You need to know how they handle claims before you trust them with your money. Effective premium optimization aligns your policy intentionally with your actual financial reality.